Good evening, everybody. Welcome to our Financing for Real Estate in 2023 presentation. We have a jam-packed evening full of great information, so we're just going to dive right on in. All right, so a lot of you here tonight I've met, your clients of mine, but for those of you I haven't met, my name is Rachel. Just a quick intro. I'm a realtor and advisor here on the team at Marshall Reddick. Just a little quick background on me. I grew up near Seattle and then moved down to sunny Southern California for college. And then a little shy of 3 years ago, my family relocated out to Texas. So I have my bachelor's degree from Vanguard University. I'm a licensed agent in both California and Texas. And my journey with Marshall Reddick actually began well over a decade at this point. My husband and I bought our first investment property and our primary residence within a few months of each other. Fast forward over a decade and a few properties later, I'm here tonight. So I'm definitely a true believer in what Marshall Reddick can help our clients achieve. I've seen it firsthand, not only for myself, but for countless clients. So for those of you that are newer to Marshall Reddick and just found this event, so we really are a one-stop shop for all real estate investment needs. So first and foremost, we're a real estate brokerage. So we help our clients buy and sell residential real estate. So some of those clients are shopping for their primary residence. I help clients buying vacation homes, while others come to us, many people, for one-stop shop investment property services. We are also a private money lender, so we help our clients by providing private money loans to help fund a variety of programs. And on the flip side of that coin, we have individual investors that fund each one of those loans. So that's a great way to invest as well. We have the Marshall Reddick Fund, which is available to accredited investors. If any of you are accredited and would like to explore that, I would love to set up a time to chat with you about it. It's a great investment avenue. I'm a participant myself, as is Reed. It's just a really incredible passive income opportunity for those who qualify. And last but not least, certainly not least, we offer incredible in-house property management services in all of our primary markets. So if you're investing in real estate long distance for investment properties, which most of our investors are, your property manager is going to make or break your success. I can absolutely speak to this as a property management client myself, as can Reed. As you can see, our team here at Marshall Reddick and with our partners is CMG. We really believe in the services that we all offer. I'm a client with all these individual facets and a CMG client, and I can speak for what all of this has done for me. So real quick, our markets. We offer brokerage services in 16 major metropolitan markets. The markets highlighted on the map here are what's considered our primary markets, where we have boots on the ground, Marshall Reddick employees, offices, etc. So these are our primary areas. I sit out of Houston myself in the North Houston Metro Woodlands area. So with that, I'm going to turn it. Oh, no, I'm not. Just kidding. Real quick, guys. These are the quick 7 facets that we use to select the primary markets we're in. So all of these are really important. I get asked that daily from investors. What makes you pick the markets that you're in? So these are the different things that we examine as a company. The job market needs to be strong, stable, steady. The vacancy rate in housing needs to be kept low. There needs to be a good amount of economic diversity across the board. Housing affordability needs to be low, good, affordable, attainable for investors. Is it a landlord-friendly state? This is crucial more than ever. We've seen this in the last few years. It is so important to have a landlord-friendly market to invest in. And are there strong education options? That's a big deal as well. And again, what I touched on a minute ago, reliable property management, that is going to make or break your investment. So Now I think I'm officially handing it over to Reed. Just some real quick intro on Reed. I've been friends with him for a long time, a client of him for the better part of a decade. My husband and I have gone through 5 loans with Reed and his team. It really is white glove service. You're not going to get a better lending experience. And I really look forward to seeing all the awesome info he has to share tonight. So with that, Reed, I'll turn it over to you.
Awesome. Thanks, Rachel. And yeah, thanks for all the kind words. And hi, everybody. Happy to be here tonight to give you guys really just like a financing update on what's happening out there and what's happening with loan programs and interest rates. So a little bit about me, proud husband and father of 2. So I got a 4- and 7-year-old and my wife, Chelsea, and we live over here in Southern California in Orange County, so San Clemente, California. If you guys ever come to the Marshall Reddick Newport Beach corporate office, I'm about 15 minutes, 20 minutes south on the freeway from there. So spend a lot of time up there, and yeah, just love where we live. And I've been a proud partner of Marshall Reddick since 2004 timeframe. So it's been a real long journey. Super excited to be here. I've also purchased, investment property myself over the years. So I currently own real estate in Orange County and Austin and San Antonio. A couple of my achievements that I'm really proud of, being listed as a loan officer, a top 100 loan officer in the nation. Bought my first property when I was 19, and then I've been able to help and work with probably a few thousand Marshall Reddick investment clients at this point. I'm just super happy to be a part of your guys' journey. One thing to note too, I'm federally and state licensed to lend personally in about 19 different states. So all the Marshall Reddick markets. I'm also licensed in like Arizona, Las Vegas. We're in quite a few different markets, at least my branch, and then my company is licensed in all 50 states. So a little bit about us, just why my company, CMG. We're one of the 10 largest banks in the entire nation. So I like the slogan that you get the big bank interest rates, but you get the small company, mom and pop, style feel. My processor, underwriter, Dr. R funder, my 3 loan assistants, everybody works for me. So it's out of my own branch. And it just gives you kind of that more personal touch feeling. But again, we're a very large bank. We have the lowest rates out there. We service most of our loans. So just a lot of the bigger benefits that you get being able to log into an online account, make your payment, set up auto pay and all that. You get that with me and my company. But again, you get more of that white glove service. And then another thing is we're doing a refi incentive plan. So anybody that buys property in 2022 or 2023, you get a no lender fee refinance in the future. We cover $1,000 of your title and escrow fees and the cost of your appraisal. We know that rates will come down eventually, and we want to make sure that you do your refinance with us. So we're going to be covering those costs for you. I think that's a really, really generous program that my company's put together. And then we specialize in investment property financing. We're the creator of the all-in-one loan, which is a first lien position home equity line. It's just a great product. If you want to learn more about that, reach out to me. And then again, I taglined it here, 10th largest bank in the nation, and then you get the big bank rates with the Reed Hazard team service. The info I'll be covering, getting pre-approved. What does that consist of? How does that give you an edge on the purchase market? Best loan programs available for buying investment property or a primary residence. A couple ways that we're getting creative as well, even though the rates are super high. Private financing options, so if you can't qualify for my type of financing, or if you want to buy with a corporation or buy out of a self-directed retirement account, I'm going to cover those options tonight. Marshall Reddick has excellent financing options for that, for fix and flip and renovation loans and whatnot. And then I'm going to do a market update, what's happening with interest rates, and do a little bit of forecasting, even though I absolutely hate forecasting right now. It's definitely not fun, but we have to have an idea of where things are going. I'm going to be talking about that tonight. So just real quick, what is getting pre-approved? You do a loan application, you upload your documentation that we request. We'll request income and asset docs, any mortgage statements for properties that you currently own. If you're self-employed, you always have to give your tax returns. You'll need to get a year-to-date profit and loss sheet, a couple of bank statements for the business account. So there's a little bit more documentation that's required when you do a self-employment loan. But the rates are the exact same as a W-2 loan, so no difference there. If you're a W-2 employee and you're not self-employed, and you own less than 25% of the business that you work for, then it's gotten really easy to qualify. I mean, we don't even really need W-2s a lot of times. We're ordering your verification of employment internally, and then we use all these documents to run your loan through the automated underwriting system. So the automated approval system of where we're going to sell the loan. Is it an FHA loan, a VA loan, a conventional loan? So we will run the loan through the system, get a loan number, and this puts you in the driver's seat to be able to write an offer to close within 30 days or less. The fastest close that we do here in Orange County, because a lot of times you're competing with all cash offers, we can close in 14 days. Most sellers and buyers feel more comfortable on a fast close doing like maybe 18 or 21 days. And again, doing this ahead of time gets you positioned where you can write offers over the weekend. You guys can close extremely fast if we need to compete with other offers. So definitely getting pre-approved is the way to go. If you're looking to buy in the next 120 days, get pre-approved. Getting pre-qualified, sure, I can run a loan app on you, do a soft credit pull. We can discuss what rates are going to look like, but that's for mortgage planning. That's for, hey, I'm going to buy maybe in 6 or 12 months, and I just want to have an idea if I qualify. We definitely don't need to run the credit yet. We can just discuss it. But when you're ready to really verify what you can do, get pre-approved 100%. It'll help you understand your buying power. It'll confirm, the max you can qualify for. You can learn what the current interest rates are. FICO score has never mattered so much. 740 FICO score plus used to give you the best loan pricing. Now 740 to 759 is a tier, 760 to 779 is a tier, 780 to 799 is a tier, and 800 plus is a tier. So the reason why is the government made financing a little bit more expensive back like earlier last year. And so they made some changes to their loan level pricing adjustments with FICO score and with down payment. So again, just really to get an accurate look at your financing and build your plan, get pre-approved. Another thing is, like, if you're looking to do a 1031 exchange, we have a lot of clients that bought property in areas that weren't really that ideal, maybe in 2005 and 6. There were people just buying all over the country back then because financing was, you could get 0 down payment loans, to buy 10 investment properties. And so people were buying property all over the place. And a lot of those markets, they didn't do a whole lot for a long time. And then COVID hit and we had sort of the great spreading and the work from home and all the capital infusions in the market. And, you've seen a lot of these markets come back and are actually a lot higher than they were back in the last crash that we had in 2006, 7, 8, when we then crashed in 08 and 09. A lot of those markets have come back and they're quite a bit higher even than what people paid for those properties in 2005 and 6. So we have a lot of clients selling those properties and doing a 1031 exchange and taking their equity and moving that equity into maybe a market like San Antonio or Central Texas, where historically it has a lot less ups and downs and there's great new construction opportunities. So, again, we do 1031 exchanges with certain clients where they may be selling a property. Actually, we had a guy a couple months ago. He sold a property in Burlingame. He netted about $2.5 million. We used that $2.5 million to 1031 exchange into 9 investment properties spread out between the Marsh-Reddick markets. He bought 3 properties in Florida, 4 properties in Texas, 2 properties in Tennessee. So again, we deal with very complex files. And if you got a 1031 coming up, you're thinking about selling and exchanging into another property, if it's your first time ever buying a piece of property, if it's your first time buying an investment property, just educate yourself, get fully pre-approved. There's no cost or obligation to do it. This is my sales team. So my partner, Al Rodriguez, he helps me out with some of the Marsh-Reddick clients. Mike Lynch, he does all of my pre-underwriting, and then I have my own underwriters that one of them does pre-approvals, one does final underwriting. So Mike works very closely with them. Mike's a wizard. He's been doing loans for over 30 years. He has all the underwriting designations. He's my insurance, right? His job is to put together the file, make sure everything works, run the DU approval for wherever we're going to sell the loan to. Again, even if we hold on to the loan and you make payments to us after closing, meaning we service it, the actual mortgage-backed security itself has been bundled and pulled and sold in the secondary market. So again, Mike is he's the one running those approvals and making sure that the file works before we approve it. Jessica, she's amazing, does a great job for us. She works with you on signing your loan disclosure. She works with the agents on the appraisals. She really is just a light of our team, and she just goes the extra mile always. She does a great job. So you'll get to know Jessica. And then I've had Leah as my main processor. She contacts you towards the end of the process. And this is the main bulk of my upfront sales team. And then there's many other people that are involved, closers, funders. But these are the people that you'll be talking to most often. And then Leah as well, you'll talk to sometimes. Couple commonly asked questions. How long is the approval good for? About 120 days. If you're not looking to buy for 4 to 6 months, I already kind of covered this, that you don't. If you just want to do some mortgage planning, that's great. But if you think you may be placing an offer soon, or if, man, the perfect deal came around right now, I would buy it, then you need to get pre-approved. If you're in a rental agreement with your lease currently, go talk to your landlord about getting out of your lease early. In some cases, they might be able to rent it for more than what you're paying due to rental demand in the area, and they might be fine letting you go without any lease break fee. So just some questions to think about if you are still in a lease, but maybe would buy if the right deal came up. Ask your landlord or management company, if you can get out without a lease break fee. What if I want to purchase more than one property? We can do a pre-approval, like I said, to purchase anything up to 10 finance properties at the same time. So that's a very extensive approval, but we can do that. And the type of financing that I'm referring to is conventional financing. The max finance properties that you can have total is 10 finance properties on a conventional mortgage. And I'm going to cover the benefits of conventional on a future slide. But again, we can get you pre-approved to buy multiple properties at the same time. And we do that all the time. Just a few things to do after you're pre-approved. Don't open any new credit without talking to your loan officer. Don't max out or overcharge on your credit cards. If your credit expires and then we have to run a new report and we don't have time for you to pay down your accounts and then do a rescore, like we could be near the end of the process, you might get stuck with those new credit scores. So try not to overcharge on your credit cards while you're in the process. Don't make any large purchases without talking to your loan officer. This is another really good one. If you're going to use whatever money you're going to use for your down payment needs to be seasoned in your bank account. That means we ask for 2 months bank statements when you do a mortgage, and we want to see, okay, they're using $100,000 for funds to close. Well, on the most recent bank statement, if there was a zero balance at the beginning of the month and there was an $80,000 deposit, we have to source it. And if it shows that money came from cash, or it's not able to be sourced, or it came from a friend or family member, someone that's gifting you money, well, on investment properties, you can't use gift funds. So if the money was put in the account 3 or 4 months ago, and we asked for 2 months bank statements and it doesn't show any large deposits at all, we won't have to note anything. And maybe you just sold money from your Charles Schwab account and moved it into your checking account. Well, we can always source that. So you'll just have to get some extra documents and source the transfer from the Schwab account to the personal account or whatever account that you're going to use. But again, that's called seasoning funds. So just be prepared to show wherever the money came from. If it shows that you've made these large deposits into your account that you want to use for closing the deal, know that you'll always have to source it. Once 2 months has gone by and the money's just been sitting there, well, then those are seasoned funds. We wouldn't have to ask for anything else. So that's why when you make large deposits, just know that they'll have to be explained. And then a few things to do while you're in the process: maintain employment at your current job. If you're looking to start up a new job, it's the same line of work, and it's W-2 to W-2, then we just need to have an offer letter, executed offer letter that has no contingencies in it, and you need to have an actual start date. And you can then make your job change, and we can still use your income for the loan, and you'll be fine. If you're going to change jobs and the process is taking a while, maybe it's a new construction property and it's going to be done in 3 or 4 months from now, and you want to change jobs, just call your loan officer, call me, talk to me, and then I can give you the advice on exactly how to do it. And then that way we can get that all done, and then we take the new employment, and then good to go. But definitely, if you're going to change jobs, you absolutely have to just communicate with your loan officer. You don't want any surprises there. And then pay off any collections or judgments or tax liens. If you're an FHA buyer, or if you have those things on your credit and you're trying to buy a primary home, we're going to advise off that. So don't just do it right away, but that's something that we would advise when we get you pre-approved. And then stay current on all of your accounts always. If you're late on a mortgage, one time in the past 12 months, you can't get a DU approval. So, and plus your credit scores will get hit pretty bad if you're late on anything. So always try to stay on time. And those are sort of the things to do and not to do as you're getting pre-approved and after you get pre-approved when you're out there shopping. So I'm going to talk real quick about how do we qualify you to buy property? Like, why are we asking for income documents? We want to find, and why are we running your credit? We want to find out what your income is and then what your debts are. And we want to find out what's your debt to income ratio. And so a simple example of that, if I make $10,000 a month in pre-tax income, so my gross income on my W-2 is $120,000 a year. And then I want to buy a primary residence. And the payment for the primary residence is $4,000 a month for the principal, interest, taxes, and insurance, and maybe HOA, if I have any. It's $4,000 a month. $4,000 a month divided into $10,000 a month of income is 40%. You'd have a 40% debt to income ratio. We then add any other minimum payments on your credit report. So any minimum payments on credit cards, not the balance amount, but the minimum payment is $80 or whatever the minimum is. And then we add any auto loans. If there's student loans, then there's a factor that we use on that we have to add a payment for that in, and even if it's deferred. And then we take that total amount, we divide that into your income, and the debt to income ratios, depending on the loan program, the highest debt to income you can have is 56.99% in general. That's about the highest you can go. And that's on an FHA or a VA loan. And I'm going to cover this in just a minute. So that's how debt to income ratio works. That's how we qualify you for conventional mortgages. Anything that doesn't make you qualify with a debt to income ratio generally will require a much larger down payment, and it's an asset-based loan. The income coming in off that property has to be high enough versus the payments. Okay, there's a ratio there that's used in the private money world, and then if the asset qualifies based on your down payment, then you can get the loan and you don't have to do any of this stuff. But the rates are higher on those programs. Longer term money, like 10-year fixed or 30-year fixed loans, the rates are much higher on those versus conventional. So that's why we always like to go conventional first. And if our debt to income ratios are way too high, but we have a lot of capital that we need to deploy, and it makes sense to buy the property, or you want to buy out of a self-directed IRA or retirement account where you can't get conventional loans because they don't lend to entities, then that's where that private financing would really come in handy. But for this type of financing I'm going to go over though right now, this is why we ask for the income and the credit documents. Conventional loan programs. So 90% of all loans that are done out there, about 95% are FHA, VA conventional loans. But I'd say like very high ratio of the loans being done in the country today are conventional loan programs. So in 2010, Fannie Mae and Freddie Mac were nationalized by the government. They used to be the largest purchasers of mortgages on the secondary market. So when a bank originates your loan and they originate, let's say 50 million this month of loans, they package and bundle those loans based on the type of loan product and they sell them on the secondary market. Well, Fannie Mae and Freddie Mac were the two largest agencies that would buy most of those loans. They would even set guidelines for most of those loans and put them out there and say, hey, we will buy loans that meet this criteria. And then banks, regional banks that sell to Fannie and Freddie, just large institutional hedge funds, mortgage banks, all these different banks on the front end market would then create those loans, and a lot of them would end up at Fannie Mae and Freddie Mac. Well, in 2009, when the banks fell apart and liquidity dried up, and Fannie Mae and Freddie Mac were not able to run their companies anymore without a capital infusion from the government, you had TARP. And the TARP funds is when the government basically, provided over $750 billion of bailout to the largest banks. Fannie Mae and Freddie Mac were so far underwater that they were completely overtaken by the government and they were nationalized. Then the government came out and said, okay, we don't want to have this all happen again. We're going to make interest rates and lending and guidelines for conventional loans. All that's going to be based off the borrower's credit and their verified income and their verified assets. And that's when full doc loans took precedence. And if you wanted to get any financing in 2010, 11, 12, 13, 14, really even 2015, you had to get a conventional mortgage because other lenders that were lending privately, they just didn't have enough capital to lend out. There was almost no private financing, no construction financing available, very little of that for many years. So the guidelines by Fannie Mae and Freddie Mac really stand tall and have for over a decade as being really the benchmark for getting the best interest rate and the lowest down payment requirement for buying an investment property or buying a primary residence. So nationally, the national conventional loan limit is $726,000. So, and that's been going up every year, and I'm gonna show that on a future slide and explain how important that is to the housing market. And that's a national loan limit. So that's anywhere in Texas, anywhere in Florida, anywhere in the nation, 726, you can get a conventional loan as the max. In high cost areas like Orange County, Los Angeles, you can go as high as $1,089,000. Why is that impactful? You can do as little as 3% down on a 726 loan amount. There's even a zero down available with down payment assistance that you can do through CalHAFA on FHA, and then there's also a way to do a conventional loan with getting basically like a silent second zero down loan. Some banks have the 1% down also. Really 3% down is the best minimum down loan in my opinion. I think it's priced the best. The mortgage insurance is pretty cheap with all things considered if you have a good credit score. And again, you can do that as little as 3% down to a 726 loan amount. On a $1,089,000 loan amount in a high cost area, you can go as little as 5% down. So it's just a really phenomenal financing that's available, and that's been going up every year. Mainly 30-year fixed and adjustable rate mortgages on conventional products, and they have no prepayment penalty. So you can pay off the loan at any time, and there's no penalty to do so. 30-year fixed, 7-year ARM, 10-year ARM, meaning 7-year fixed or 10-year fixed, that are amortized over 30 years. So the payback period is 30 years, but they're only fixed for 7 or 10 years. Fannie Mae, there's pretty good options on those types of ARMs. 30-year fixed, and then of course you can do like a 15-year amortized 15-year loan or 10-year amortized 10-year fixed loan, and the rate's a little bit better versus 30-year fixed, although those spreads are not that great anymore. You don't get a much better deal on the rate for doing a 15-year loan or a 10-year loan. But again, all options we could discuss together. The lowest interest rates for higher credit tier borrowers. So if your FICO scores are like below 680, I mean, regardless of the down payment, you almost always will do a lot better than doing an FHA loan. It really just depends on the down payment. And like I said, usually anything below 680, the loan pricing just looks a lot better on FHA. Conventional financing, anything below a 620 mid-score, you can't get it approved at all. It doesn't matter what the down payment is. So it's a lot more credit sensitive, conventional financing. But yeah, I mean, really best rates, lowest down payment requirements if you have good credit. And then you can do up to 10 finance properties with conventional mortgages. This is available on investment property or primary residence or second home. So the max debt to income ratios for investment property or primary residence on conventional is capped at 49.99%. These were the loan limits in 2022. So on the left, on the very top, 647,200 was in 2022. We had a lot of wage inflation and a lot of home price appreciation in 2022, which it doesn't surprise me that they raised the loan limits over 10% for the following year. And on the right-hand side, this is how high that the high-cost loan limits were. So now it's $1,089,000. In 2022 was $978,000. So they really increased that a lot. The next one down where it says 2 is for a duplex, and then a triplex, and then a fourplex. I mean, you can literally buy with 25% down. You know, you could buy a 4-unit property and get a $1.867 million loan against that property in 2022. Let's look at what it did in 2023, all the way to $2,095,000. You could buy a fourplex, you could find one in a good location for 2.5 or 2.9 or $3 million, and at least be able to get conventional financing on over $2 million right now. So duplex high cost loan limit 1.394. You could buy a nice duplex in Dana Point for $2 million and be able to finance with conventional financing at almost 1.4. Now, these loan limits, this is a chart showing you 2003 through 2023, so the last 20 years. you can see here in 2003, 4, 5, we still had some wage inflation in the economy back then. The jobs market had recovered from a recession in the late 90s and started doing better again. And then we had the dot-com boom, and we had just a lot of growth happening around 03, 04. And so Fannie Mae loan limits had started to go up a little bit, and appreciation on homes prices started to go up. And then obviously it was going up a lot back then in 2004 and 5. 2006 started to kind of top out a little bit. It started getting a little bit funky, and the government started seeing that. Fannie Mae, Freddie Mac, because they were the buyer of most of these loans, doesn't surprise me that in 06 and 07 that they stopped raising their standard conforming loan limit that they would lend on. And you can see in 6, 7, 8, 9, 10, wage inflation dropped off a cliff in 2008 and 9, right? And then people couldn't get jobs. They couldn't hold on to their homes because the pick-a-pay mortgage, where you had the option of paying 1% of your 6% interest rate, that's what you were making your payment on, or you could pay the full interest payment, the 6% interest rate payment every month, or you could pay the principal and interest at a 6% interest rate every month. Most people were just picking to pay the 1% option. The other 5% they weren't paying every month was being added on top of their loan balance, causing it to increase over time. Then they only had the option to do that maybe for 2 or 3 years, or even 1 year pick-a-pay loan. And then it would adjust to where then you had to pay the principal and interest payment with the full interest rate included. And they were never qualified to buy the property to begin with, because they bought with a stated income loan where they stated what they made and they stated their assets, and they bought with zero down. And so all of this combined, people couldn't hold on to their homes. The minute that those payments went up higher than what they were able to afford, then they lost those properties. And then we saw the market in general, because of the housing crisis, really fell apart in the employment market. Unemployment went to over 10% in 2010. And all those homes got added into the market, and all that inventory got added into the market, right? And financing was hard to get for many years. And then right around 2015 is when we started to get our first signs of life in wage inflation, because the 10% unemployment rate dropped down to about 5. And if the unemployment rate is lower and the amount of available jobs is increasing, then employers have to pay more wages to people to get them to come on the job, right? And as that employment rate went down more and more in 15 and 16 and then in 17, when we had a new president-elect and he got tax reform passed, then you just saw basically the unemployment rate go down to below 4% even. And the amount of available jobs kept increasing because companies were making money again, and we had some expansion again going, right? So as that started to happen and the housing market got back on track and wage inflation started to go up again a little bit, by 2017, wage inflation was at 2%. And then we also had tax reform, and corporate tax rates, if any of you remember, went from 38 or so percent down to 21%. And that additional money that these companies were saving, they gave a lot of that back to their employees, and they increased wages. And as a result, in 2018, wage inflation had gone from 2% to hitting 4%. And if you guys remember, in 2018, because of that, the Fed was worried about inflation in the economy because people are making more money. They're going to spend more money than the amount of products and goods and services out there. There's going to be higher demand, and then prices are going to go up, and inflation's going to go up too high. And they were afraid of that. So they started hiking interest rates in 2018. They hiked it at every live meeting, which is a quarterly meeting back then. Right now, every month it's a live meeting. They could technically hike rates every month if they wanted to because it's such a hawkish environment. But back then, it was quarterly, and every quarter they hiked rates that year. And it's funny because in 2017, 30-year fixed mortgage rates, when we were at about a 2% wage inflation, a little bit below that, I think I was at 1.6. And the housing market was growing, but back then around 2017, it was a type of environment that you were sitting around wondering, like, what's going to be the next thing that's like going to cause values to go up right now? Are they just going to slowly go up over time? There was still less inventory. Inventory was definitely getting low, but you know, there was definitely enough inventory on the market. The jobs market was growing at a normal pace, or really even a little bit subnormal. It was growing still pretty slow. And everybody was kind of waiting around for the next thing to happen, whether it was going to be good or bad. And then Trump got elected, and then he got tax reform passed. And I don't have any view on what was good or bad or any of that. I'm just talking about what the effects were. And those effects, man, they caused wage inflation just to go crazy. And so, again, the rates were about 3.625 when we were in that just very natural growth, like, you know, low unemployment rate, a good amount of available jobs, but not too much wage inflation, housing market continuing to get better, the amount of monthly and annual builds, you know, they had gone from a dismal 400,000 a year in maybe 2012, 13 to about 700,000, 800,000 again. So, you know, inventory seemed like there was going to be enough inventory to handle demand. And then wage inflation happened due to tax reform. And the Fed interest rates went from 3.625, 3.75, all the way to 5% within a year. It's kind of a similar thing that we saw happen when the Fed started hiking in early 2022. Although our inflation was much stronger than that at that point. Still, we can look at what happened and how the Fed's hikes slowed down the economy through the end of 2018 especially. And then even in 2019, they hiked that fourth time, the end of 2018, and they actually had to cut interest rates in early 2019 because a lot of that extra money that had filtered into the economy due to the wage inflation that we saw, due to tax reform, started to get, you know, it was out of the consumer's pocket. They were spending it. They had spent through it. The higher rate environment cooled things down a bit. And then we just kind of sailed into the sunset. We didn't even have a recession. The jobs market was still very strong. And as interest rates came down, as the Fed cut rates a little bit, it seemed like the market just sailed into the sunset. And rates went from 5.25 at the peak of 2018 to about the lower fours. I think they even hit the high threes by the end of 2019. Then in early 2020, actually in summer of 2019, I remember that they had hit like 3.75. Then they went back up again a little bit, and then they went down into the end of the year. And then in early 2020, not related to COVID, the federal fund rate was about 1.75%. So it was 1.75 to 2% back then. And the wage inflation was back right around 2, what the Fed wanted. They didn't have to have rates at 0. They had found what they believed was the perfect sauce for the economy to grow at a pace that was sustainable, for inflation and wages to both grow at a sustainable pace where you could continue increasing over time, but not go into a recession and still grow. Then COVID happened, right? And as you guys could see, the market actually dropped right away for a couple of months. People got insane deals. And then by like the time that all the lockdowns kind of ended, depending on where you're at, they might have taken even longer. But, you know, around like late summer of 2020, you started to see more reopenings. And that's when I think with the rates being so low, you started seeing home price, you started just seeing purchasing really pick up. People realized, wow, I didn't even lose my job. Or some people unfortunately did, but a lot of people didn't. And a lot of people actually started making even more money during that time, depending on what industry that you were in. And by the end of 2020, you could tell there's going to be a lot of home appreciation going into 2021. At least I could tell. It was still very scary, though. We had another resurgence of COVID in the end of 2021. In the end of 2020 going into 2021. And that was actually when I bought my house that I live in right now, very beginning of 2021. I contracted in January. And I remember, it scared even the sellers that I bought it from. And I think I got a better deal because of it. But it really ebbed and flowed. And then, man, going into like mid 2021, real estate market was really on fire. And you started seeing that wage inflation was just going crazy. And so wage inflation has a lot to do with this. So does home price appreciation. And you guys can see that the Fannie Mae loan limits went up from 2021 to 2022. It was over 10%. I think it was, look at that, about 15%. And then over 10% from 2022 to 2023. So what's happening with the housing market right now specifically? Annual home sales came in a few days ago at 675,000. That's the annual pace. and the market was expecting 700,000 annual pace. Last month, it was at a 715,000 annual pace. So you saw in the last month, the annual pace dropped off a cliff. I'm not surprised by that. There is no inventory out there. I mean, depending on your market, there might be, more inventory, maybe due to the time of the year, maybe more than you had maybe in June or in May. But I got to tell you, even if you're an all cash buyer and you're buying all cash to avoid high interest rates, and you're placing aggressive offers, there's just not a lot to choose from right now. There just really isn't. So it showed that in the data. We're in a very strong jobs market. Default rate is almost zero, but the amount of home sales is decreasing rapidly. It seems like as interest rates go up, people just decide not to sell, and that almost keeps demand high and it's keeping prices high. And they don't have a lot of motivation to sell because they can afford their monthly payment and they have a strong job. It's just a really an interesting world that we're in right now. It's unlike anything you could. This is what a very strong jobs market looks like. Extremely tight job market. I mean, COVID was just. It was very hard and sad and difficult for a lot of people. And I'm not going to say it was a positive thing at all. It was just. It was very. I don't want to say extraordinary. Just very unusual. Very unique. Normally when you say unique, if you say unique, that's a unique thing. I would say it was very unique, and we're seeing that right now with how growth has just stayed so strong in the jobs market, so strong. And I'm going to talk about why that is in a future slide here. But yeah, again, housing for it to fall off a cliff like that is just unreal. It just goes to show there's almost no homes on the market anywhere in the United States right now. Now, the FHFA home price appreciation, FHFA sees every appraisal that comes in for every conventional mortgage in the United States. So if it's a conventional loan, Fannie Freddie, if it's a FHA loan, if it's a VA loan, those loans go through a system with the FHFA and they get that data. And so it's a much more it's a sample size on the entire economy, not like the Case-Shiller that looks at 20 of the largest metros and says, what are they doing? So Case-Shiller Home Index is not going to be nearly as accurate. And the FHFA is going to be a wide range on the entire United States. We showed month over month as the amount of homes that were sold annually dropped to 675, home price appreciation went up 0.8%, while interest rates surged about 0.5%. So the market, why the Fed at their meeting last week was more hawkish about where rates need to be the next 2 years, and they increased those projections on how high they think the rates need to be, is because the market is showing that it can handle rates where they've been this past year, and that we're not in a recession or moving into a recession. It's actually quite the opposite, and you can see it in the data right now. The Case-Shiller Home Index, which looks at the 20 largest metros, this looks at a couple markets that are very, very dismal, markets that solely run off of manufacturing, and we've been in a manufacturing recession, okay, where the indexes show that we're not growing, that we're contracting. And there's many Philly Fed manufacturing index. There's many different readings that come out every single month, and they show manufacturing has been in a recession, okay, because we're a service-based economy. We grow based off services, everything from a waitress that gets a tip when you go out to eat to your stockbroker. Like, we use services more here, and then we import a lot more of our goods from the rest of the world, okay? So we don't grow as much off manufacturing. About 75% of our economy grows off services, and 25% grows on manufacturing. Case-Shiller takes into account some of these metros that are mainly based on manufacturing, where there should be more contraction, yet still, month over month, real estate prices in those 20 metros grew by 0.1 month over month, and 1% they eked out a gain in the past 12 months, even with rates tripling. 2.5% the end of 2021, 7.5% give or take right now, in the past 12 months. Call it maybe a little bit longer than that now. Call it 18 months, right? That they tripled. They've more than doubled in the past 12 months. So this goes to show how strong the economy is right now. And then I wrote that they're not surprising with low inventory and a strong jobs market, even with higher rates. So will Fannie Mae increase loan limits in 2024? It's very likely. Wage inflation was hovering at about 6% at the peak. And wage inflation now is only, it's about 3.8% right now, far above the Fed's 2% that they want to see. And FHFA puts the annual appreciation by the end of this year somewhere around 3.9%. So I think that they'll probably raise it by close to that amount. We'll find that out at the end of November. It'll be posted on their website, FHFA loan limits 2024. And I would assume you're probably going to go to $754,314 for the standard nationwide conforming loan limit. Again, it's at $726 right now, meaning you'll be able to do as little as 3% down to that loan amount size. And that you'll see Los Angeles, Orange County, all the high cost markets, Bay Area, other areas around the nation that have high cost markets where that loan limit in that county is higher than the standard conforming. The highest I think you're going to see it go in the highest cost markets is $1,131,471,000. So how are we getting creative in a market that has such high interest rates? In this example, let's say your interest rate is 7%. You see that right there in the middle towards the top right there. It's a 360-month term. It's a 30-year loan, 7% interest rate. The loan amount is $715,000. Now, your payment would be $4,757. You can, at the very bottom right, you see that 2% that's highlighted. You can pay a buy down fee or have the seller pay it for you, right? Maybe you can negotiate a 2% of sales price credit, right? Or 2% of the loan amount credit. And then that money can be used. And what happens is the first year, instead of 7%, you're going to make payments on a 5% rate. The second year, it's going to go to 6%. The third year, it will adjust to the 7%. So we'll read, is the difference between my 5 and 7% interest rate, is that going on top of my loan? Is that being negatively amortized? No. Part of that 2% buy down fee that you're paying or is being paid for you at closing is going to be held in an escrow account with the lender. And whatever the difference is between the actual 7% payment and the 5% payment for the first year, that difference is going to come out of that escrow account and it's going to go towards paying down your loan balance and pay that for you the first year. It's to help you ease into your payments. The second year, same exact thing. It's going to raise to 6%, and the difference of the payment between the $4,757 and $4,286, that difference in payment is going to go towards the actual payment at 7%. And then on the third year, it's going to adjust to the actual interest rate. You can also do a 3-1 buy down. You have to pay more up front because you've got to cover an additional year of the difference of interest between these options. But this is a way that a lot of builders are offering incentives for these right now on primary homes. This is a really good way that you can ease into your payment. And with the way inflation's going, in 2 or 3 years, we're probably going to, reach the Fed where they're finally cutting rates, and we're in an environment where they don't go down a lot, but that they've stopped going up and they've come back down a bit. And maybe you can refinance your 7 or 7.5% interest rate to 6.5 or 5%. And so the idea is this will help you ease into your payment, and then you do a refinance when rates come down. So that's one way that we're getting creative right now. The all-in-one loan, if you have a paid-off property, this is the cheapest home equity line in the market right now. It ties the equity line to your checking account, allows you to operate like a bank. You can go to allinone.com and look at it. It was created by Chris George, who's the owner of our company. Just a fascinating product. It's not for everybody, but it works really well depending on what type of buyer that you are. And contact me for more details. VA loans, you serve our country, you deserve to get the best financing out there. When you put less than 20% down, you have to pay mortgage insurance. You can buy that mortgage insurance out, but it's going to get built into your interest rate. So most people decide to just pay monthly mortgage insurance when they put less than 20% down. And when you do a VA loan, though, you can put 100% financing. You can go 0 down and have no monthly mortgage insurance. You also could buy a duplex and live in one side, rent the other out, and be able to buy it with 0 down. So it's the lowest down payment on a duplex type of loan that you can get. The next best option, if you wanted to buy a duplex with minimum down payment, would be FHA. You'd put 3.5% down. And then on a conventional Fannie Mae Freddie Mac loan, it would actually require 15% 6% down as the minimum for a two-unit property. So that's one of the perks of a VA loan. A lot of clients that I work with have been buying and living in one side, renting out the other, living in it for a few years, refinancing the loan to a conventional mortgage, and then buying another one and doing it again and again. And so there's all different strategies that you can use with the VA loan. And VA is mainly for primary residents. W-2 or self-employed are okay. So if you've been out of the military now for a long time, but you still obviously have your VA eligibility, have a new job, that's great. We just qualify you based on your debt to income ratios based on that new income. And then you can go to, depending on the bank, there's no cap on VA financing on the loan amount. So you can do, we have a guy at our company that lives on Coronado. He's done like $5 million zero down VA loans before. So the biggest one I ever did was a little bit over $2 million. It was in Newport Beach. I think it was end of 2020. It was $2.2 million zero down at a 2.25% interest rate with no mortgage insurance. So tell him what he's won, Bob. A 2.25% with no mortgage insurance on a $2.2 million loan. So that will never probably be available ever again. But again, that was done with the VA loan. So just an amazing, amazing loan product. FHA financing, great for first-time home buyers. Or if you have like challenged credit, but the credit's, it's good enough to qualify, but maybe your credit scores are in the lower sixes, or I even just got somebody qualified with a 546 mid credit score. They had compensating factors. They were putting a larger down payment. They weren't doing the minimum down of 3.5. They were doing like 13% down. They had some savings, so they showed that they had some reserves after closing. There was a lot. They had a low debt to income ratio. The debt to income ratio was 38%. Right? So, but they just don't have very good credit scores. They had some issues during COVID and had to do forbearance, which we didn't impact them for that, but their credit got impacted due to other factors around that time, like not making payments on things, having some charge-off accounts and some lates, and their credit didn't recover. But again, we were able to get them an FHA loan. So if you have really good credit and you want to buy a duplex and put minimum down, 3.5% down. So we have a lot of clients that have flawless credit, but that are buying a 2-unit property and don't have the money or want to put that much money down. They're going to live in one side. You can do 3.5% down. And you can go as high as a 56.99% debt to income ratio, and it's for primary residents only. Jumbo financing is any loan amount above $1,089,000 in the market. Next year, if that loan amount does go up, like I think it will, it'll be anything above that amount, and that's jumbo. And generally, you need 20% down. You need to show you have 12 months of the monthly payment for that property in reserve after closing. So how much extra savings do you have, right, after the money you're going to use for this deal? How much are you going to have left over between savings accounts and retirement, whatnot? You have 12 months or more of monthly payments for the home that you're buying, then you would qualify from a reserve standpoint. Debt to income ratios, they just want to see that you make more money versus your payment when you buy with jumbo financing. So 45% is the max. Most jumbo investors that are buying jumbo loans don't want to see anything above 43%. And then self-employed borrowers, definitely okay, same interest rates. Just again, you got to supply more documentation when you buy with self-employed loans. And the standard's generally 20% down, but there's some banks that'll do 10% down still, I'm sure. The rate pricing is nothing like it was at 10% down. I'm sure it's much higher than 20 right now. For me and my loan programs, really 15 or 20% down is where you want to be for doing a jumbo loan. And then ARM financing options, 5, 7, and 10-year fixed. The rate's a little bit better versus a 30-year, so we can always discuss that. But the spread is not that big right now. I mean, you're not getting a big benefit anymore for doing an ARM versus a 30-year right now. There's me doing the same thing, working with investors. And this is when I had just gotten a real estate license and started working with American Direct Mortgage. I think I was not even 20 there. So doing what I love. Again, I really built my business here with Marshall Reddick. It's my flagship, and just grateful to be here, still doing what I love. Down payment requirements for investment properties. So we've talked, about those programs here over the last couple minutes. Those are mainly for primary residents. Conventional loans, remember, you can do investment property with conventional loans, or you could buy with FHA or VA and buy a duplex and live in one side, rent out the other. So that has an investment aspect to it. So when you're buying 1 to 4 finance properties, the credit score is super important, and the higher the credit, the better. You really want to be over 700 mid-score minimum when you're buying investment property if you can be. Like I talked about those tiers earlier, even 800 plus, you're going to get better pricing now. Where it's always been 740 since like 2010 until recently. It's 740 was the best pricing you can get. Again, now it really does matter to have those extra 20 points. Pretty cool. 1 unit minimum down payment is really 15% down on investment, but you'd have mortgage insurance and the rate pricing is atrocious. I would not do 15% down. I would do 20 as an absolute minimum and expect to have some negative cash flow, unless you're just getting an absolute, deal of the century. I'm sure maybe there's something that's going to come available or available out there that it could work, but man, that's a total unicorn. I would be prepared to put around 30% down on a single family home right now is as really a minimum to break even or get some positive cash flow. And the return on investment is still very good. If you go to marshareddick.com, click on the investment tab, click on properties, you can filter out any city that you want that they sell property in. You can click on any property, scroll down the page, and you'll be able to see their financial calculator. And you can literally, depending on the down payment, you put more money down, your return on investment tends to go down a little bit because you're putting more cash into the same asset that's going to appreciate the same based on its price, right, over time. So more money down, a little bit lower return on investment, a little bit higher cash flow. So there's kind of a sweet spot there. And so I play with that calculator nonstop. You might want to put 40 or 45% down and your return's a little bit lower, but it's safer because you have better cash flow over time. You may go, I'm okay with some negative cash flow. I make however much money a year and this difference of a couple $100 or $500 a month, I'm fine with it. My return on investment is actually going to be higher over time based on the calculator. And you might be okay going with less down. We advise putting 30% down in this market as a minimum, maybe 25% depending on the property and depending on if it's a 2 to 4 unit. And that's why if you go on the Marshall Reddick website, you'll see that all properties default to 30% down. And then as you grow your portfolio of property and you now have 7 rental properties or 8 rental properties, the rates are the exact same. You just have to put a minimum of 20% down. And on 2 to 4 unit, 25% down is always the minimum. No lender in the nation has a 2 to 4 unit that with less than 25% down. That is the benchmark minimum. And you've got to have 720 mid FICO scores when you go to 7 to 10 finance properties. So you won't be able to get a desktop underwritten or a manual approval with a FICO score below 720 mid score. So we all have 3 credit scores: TransUnion, Experian, Equifax. The middle score between the 3 is what mortgage financing is based off. Got to be at 720. So to get to 10 finance properties, that's sort of a magic number for people. You can scale a rental portfolio up to 10 finance properties relatively easy if you're using Marshall Reddick Property Management. You log into your website with Marshall Reddick, your 1099s are in there every year, your annual cash flow statement showing how much expenses that you had is in there. You get your 1098 interest form from your lender and you supply these documents to your accountant. He lists all of this on your Schedule E for each property. And it's actually pretty easy to scale a portfolio of up to 10 finance properties. That will also create a lot of generational wealth. And depending on the property class, that could be extremely significant in 10, 20, 30 years from now. So we like to look at 10 as kind of the standard max portfolio that our investors buy to. And some buy a lot more than that. Some, 3 or 4 or 5 is good. So again, getting to 10 though, 720 mid FICO. Got to have 6 months of the monthly payment in reserve for each property when you go to keep buying. So you're going to have more savings, and you should either way. It's the better way to do it. You don't ever want to be in a position that you can't hold on to a property and where you have to sell it in the wrong market, because real estate does go up and down over time. Over time, it goes up ultimately because of population growth and the fact that land is a commodity. And if you're buying in the right locations with good school districts and low crime rates, most definitely people will continue to gravitate to those markets and those areas within the market when they have money. So you will see it go up over time, but it does go up and down. It does ebb and flow. Right now we're in this period where it's very flat, and so again, you don't want to ever have to sell in the wrong market. So keeping these reserves as you build your portfolio is extremely important. Don't put the cart before the horse. Don't go buy with every last dollar you have just because you can qualify to get that. You really want to, if anything, try to have more than 6 months PITI in reserve for each property as you build the portfolio to make yourself rock solid. Max debt to income ratio of 45% as you go above 7 finance. So they want to see you're making a little bit more money also. And then it's for 1 to 4 unit properties only. What else you need to know to get to 10? You can have multiple loans attached to these properties, but you can only have 10 finance. So if you want to get a second mortgage on an investment property or a home equity line, behind your first loan on an investment property, it's not going to count as now 2 finance properties. It's about the amount of properties that have conventional loans on them. Whether there's 1 or 2 on each property wouldn't matter. So you can have multiple loans, but can only have 10 finance. You can do purchases or refinances on a primary residence, regardless of the amount of finance properties that you own. So technically, you could have 11 finance properties if you bought 10 investments first and bought your primary last. And it's for 15 and 30-year fixed financing available when you go to 7 to 10. I think you can actually get a 7 or 10-year arm nowadays on that too, but you wouldn't make any sense to. There'd be no difference, almost no difference in pricing. So think 30-year fixed. Other frequently asked questions: can we use 75% of the rental income towards qualifying? Reed, I'm at a 48% debt to income ratio, but I have a couple $100,000 and I want to buy a few investment properties. Awesome. We need to put enough money down so that 75% of whatever the rent's going to be on that property, we take that income. So if it's $2,000 in rent, we take $1,500. We add that onto your income towards qualifying. And if the total monthly payment on that new property, because you're putting 30% down, $1,500, well, 75% of what it's going to rent for is $1,500. We add that onto your income. Now that debt cancels itself out. Your debt ratios are still under 50. So we can do that based off of a lease agreement as you buy property. And how we factor that in is when we get the appraisal done, we get a 442, which is it's a rental comparable analysis that's included with the appraisal, and the appraisal will show 5 or 6 other comparable properties like the one you're buying, and the location and proximity from your property, the square footage, the bed and bath count, show the age of the property, the condition of the property. It's a lot of data on an appraisal. And so that's how the value is created. And then they do the same thing with rentals. They get other properties just like yours within a couple mile radius, what they're renting for, and then they take an average of that, and that's what you're able to use towards Xing out debt towards the new purchase, right, towards your debt to income ratios. So if you already have 10 finance properties and you're trying to buy an 11th or 12th or 13th, Marshall Reddick is the next best option 100% of the time. They've got great 30-year fixed options. They've got great 5-year options. The best out there for this type of financing. Another thing, though, that they do rigorously is renovation loans, bridge loans, new construction loans. So definitely reach out to them if you've got a project coming up or a single family where you want to buy it, renovate it, and then do takeout financing with me and get a long-term loan that we refinance their loan, right? We pay off their loan and give you a new loan when the property has been renovated. We do that all the time with their private lending department. So just reach out to me or reach out to Rachel. We can get you connected with the private lending team. Now, talk a little bit about interest rates, and then I'm going to wrap up with just a little bit about the market, what's going on. So why do we care about interest rates? Every 1% rise in rate is affecting your cash flow by 12%. So obviously, there's different methods of buying right now. You can pay higher upfront costs to buy your interest rate down, and you will therefore get better accumulated cash flow over time, which if you're holding the property for 10 or 15 years, you will recapture those costs of buying down your rate, and your accumulated cash flow will actually cause your return on investment over the years held to go up. And so I go over several examples with my clients on the Marshall Reddick website on the calculator to really show and explain that. Because the general, even smart investor that's doing this all the time or knowledgeable investor, these are principles that I promise you many people I talk to, they're not aware of it. And it makes sense too. You look at it on a calculator though, and then, we do that breakdown together, and you'll understand why I'm selling huge buy downs in some cases, right? And in some cases, why the borrower is taking the highest rate possible that doesn't have any points. Maybe they think that they're going to refinance in a few years. Maybe they're doing a renovation on the property and, they already have some negative anyways every month, but they're going to do a value add and then they want to refinance that loan in a few years or in a year. And hopefully rates are maybe a little bit lower by then, hopefully, right? So there's all different strategies there, but just know the difference in 1% in interest rate is going to cut into 12% of your cash flow. And rents right now are only going up about 3% a year again. So, these are reasons why we like to look at rate buy down. We have the lowest buy down rates in the nation out of any other lender. We have our own capital markets department and our own securities department, meaning we actually bundle and pool loans that I'm originating into bond pools. In some of those pools, we are purchasing with CMG securities, or we're selling those pools with CMG securities to other investors in the secondary market. And we're able to get rate sheets that most banks that are working in the middle, or even the biggest retail banks, they're not able to lend money out that cheap because they need to keep their deposits up right now. And so we have access to the lowest buy down rates out there. We really do. And it can make sense in some cases. Some cases, like I said, you might not want to do it yet. You might want to just take a higher rate, maybe put more money down even, right, and then do a refinance in the future. It really depends on you. Every buyer, every borrower is going to be a little bit different, whether you're all cash or you're financing. Okay, now what have rates done since the very beginning of 2022 when they did their first interest rate hike? Here's a trend line of that. I've got another slide that's a little bit further down, and I was really hoping that last November when consumer price inflation had a double peak event, and we saw pricing improve on the 10th of November, and then from there it got better at the end of the year. And then inflation has slowly been coming down all year. It's not at the Fed's 2% target yet, and the economy has been holding up very, very well with right around where inflation is right now, which is about, closer to 4%. So it means that the Fed has more work to go. But, again, we were really hoping that last November was going to be the end of it. As you guys can see clearly right here, we've been marching back up again, and it's very possible that we'll continue to see new highs in interest rates over the next few months. Here's a chart of the 30-year fixed mortgage all the way back from 1971 until now. I've highlighted 7.5% as sort of a benchmark. Right now, you can see on that trend line over to the far right, look at how low that rates got. It's just unbelievable. They were at, 2.5%. They hit that twice during the whole COVID run. And now, again, back at 7.31% as of today. I pulled this today. So it's data on 9/28 based off today. There you go, 7.31. We've ticked up almost 0.2 of 1% just in the past couple of days. I'm going to get into that here in just a minute on why are rates surging again? Why are they going back up? And it's not that they're really surging, it's that they're adjusting. I'm going to talk about that. So just a peak versus the current peaks that we've seen. There's that date, November of 2022. Inflation looked like in October, man, it might not be going down at all. And it had peaked in July, but then started to resurge again. And then it actually ended up going up higher, and it did not double peak until November. When we got that data for October, we got that in November. And so October inflation was when it peaked. What month are we in right now? September. When did it essentially peak last year? Was in October. We're seeing the same trend, the same run up. Oil prices are stubbornly high again, much higher than we want to see them. But that only, the Fed has stated that they can't control the food and energy component of inflation, although I think it is going to hit core inflation and GDP and make it stronger. And I think it's problematic, but it also could slow down the consumer. You could start to see less consumer spending. You could start to see that savings accounts are continuing to get more and more depleted, and that the COVID cash is bleeding off, and that they start spending less. And that will actually counteract higher oil prices. I don't think you'll see that maybe this month, but you'll start seeing it more into the end of the year, hopefully. I don't want the economy to crack, guys. I just want it to slow down, and I want interest rates to start finding their way and stop going up. Okay, so when we talk about that, I think though that oil, again, as it is highly inflationary, it could also be a headwind for the U.S. Consumer. And right now, as you guys can see, we sort of hit that same range we were at back in November of last year, and now we're shooting higher. A lot of it, this is all being done by the government. They are technicians right now. They're selling their debt into the market, forcing yields to go up. And I'm going to explain that in a minute. That's why they didn't raise rates a couple weeks ago, but interest rates are going up higher because they raised their projection for the next 2 years on how high the rates need to go. And they stated we're going to continue to do quantitative tightening. And that means we're going to flood the market with our debt. And I'm going to cover that in a minute. And that's the real reason why rates are going up at this moment. So what have rates done, okay, since last year to this year? This is an 18-month chart, okay? This gives you guys a clear view, and it looks like a different language. I'm going to break it down, though, right now. So every one of these little lines right here is 1 day of trading, Monday through Friday. It's open the same time as the stock market. Green, a day where you see green and this is going up, is investors, institutional banks, large hedge funds, our own government buying mortgage-backed securities. Mortgage-backed securities, every $5 million bundle of loans that's being done, right, by banks on the front end of the market, they're bundling and patching them and selling them on the secondary market to investors, generally based on conventional guidelines, so that they could be sold to Fannie Mae and Freddie Mac. But Fannie Mae and Freddie Mac are not really buying right now. In fact, they've been doing quantitative tightening where they've even been selling. You look at how much that they hold right now in mortgage-backed securities, and they're not doing a lot of selling. They actually have still even been buying. But there's just so many less loans being done right now in the market versus, with refinances being so much lower, the volume being so much lower than it was last 2 years, inventory being so much lower, that the Fed not buying and the outlook for rates being higher for longer is causing other investors that traditionally buy mortgage-backed securities to not buy mortgage-backed securities and sit on the sidelines as yields continue rising. They will buy back in heavily at some point, but we're just not there yet right now because of the inflation outlook still being so high for so long. So I want to point to these three highlights right here. So green is appreciation. It's investors buying bonds, causing the bond to appreciate, driving the yield down, making rates better. Red is when investors are selling the bond, causing the bond to depreciate in value, which drives the yield up and it makes rates worse. That's why on the far left side of this track, we're way high up there. That's when rates were way, way better. As this security has sold off over time, you can see that we hit the worst rates last year, right in October, and then hit them again in early November before we got that great CPI print. I think it was on the 10th of November in 2022. Rates got to the best levels that they had been at in a few months, and then from there, kept on trying to get back to those sort of September levels that we had from 2022, and we just weren't able to break above it because as we reopened in 2023, the jobs market didn't look like it was getting hit that bad. Wage inflation was still very, very strong. I'm going to cover it on a future slide, but why has wage inflation been so strong? Why is the Fed raising interest rates? During COVID, money was so cheap for so long that companies were creating jobs like crazy. They were opening new departments. They were using all of this cheap money that they got from the government through lending facilities during COVID, and they were using the Fed's zero interest rate to borrow money at very, very low levels. They were issuing corporate bonds that debt was getting bought at extremely low levels, and they were using a lot of this money to expand. You also had 3 million people retire during COVID. These were high-paying, skilled employment jobs. These are people that buy homes. These are people that sell homes. These people quit their jobs. They didn't go back to work or they retired. So you had more jobs created because of the zero money policy, and you had more jobs available because of people not going back to their job. So prior to COVID, we had 7.5 million jobs available. The job opening and labor turnover survey showed you had 7.5 million jobs available. After COVID, that went all the way to 11.5 million jobs available with the same unemployment rate, meaning we didn't have more people to work the 4 million extra jobs that we had. And that caused, when a company needs to hire a new programmer and they can't find that programmer out on the street, they got to go and poach them from Google to get them to come over to to another software company like Oracle. And how do you get them over? We'll offer them a 20% raise. Well, all that wage inflation is what is continued to fuel spending, even though prices of things have continued to go up. And the prices of things kept going up because of supply and demand, because we used up a lot of the products during those lockdowns with COVID when nobody was making new products. So as those products on the shelf got eaten up, and now you got to go and make new product to fill up that gap later, there's a demand shock in between that, and it starts causing prices to rise. That with the wages that can continue to make the price or pay the prices. Plus, people saved a lot of money during that time. And then so they have extra money to spend, and then everybody wants to go out and do stuff and travel and spend money because they were locked up for a while, right? It was a crazy deal that we went through. All those imbalances, especially the job side. That's why the Fed has been raising interest rates, and we started to see that data very clearly that wage inflation was not coming down fast enough, nor was core inflation, nor were rents coming down fast enough early in the year, showing that the Fed's policy was on the right track, but not slowing it down fast enough. And so we got through the year, and now we get to where we're at today. And interest rates are hitting the highest levels the last couple of days that we've been at. And part of why that's happening is, like I said before, with the Fed issuing debt into the market and not buying. They're not buying mortgage-backed securities right now, and the outlook is for higher rates for longer. So investors in the secondary market are not buying mortgage-backed securities, and the loans that are being done, the yields are having to go up higher to create more demand to buy those mortgage-backed securities. And so how much higher can we go from here? We can still go quite a bit higher. At some point, though, growth's going to stall more, and you're going to see things come back into balance, and you're going to get interest rates are going to come down a bit. So inflation has peaked. It did peak. Why are they still going up? We're having ebbs and flows. We're even having a resurgence right now in inflation with oil prices going back up and the jobs market still being so tight. We've made a lot of progress, though. We had 11.5 million jobs available right after COVID. We are now down to 8.8 million jobs available. And every month that JOLTS report comes out. At some point, we're going to get back down to 7.3 or 7.5 million, which is where we were at before COVID at some point. And as that happens, probably see the unemployment rate tick up a little bit more from where it's at now, not to recessionary levels. The job market's pretty dang strong. Unless the Fed pushes rates up to just some insane level, we're probably, not going to see a recession. We're probably going to see what's called the soft landing, where the economy keeps on chugging but slows down enough that the Fed can ease off of the gas of raising interest rates through quantitative tightening and raising actual interest rates. You'll probably see that happen, and then they'll even start cutting interest rates as growth stalls at that 2% level that they want to see, and rates will get better over time. But there's still too many available jobs versus the amount of people to work them. You have some labor hoarding going on as well, because companies are expecting rates to get better at some point in the economy, to get a little bit more, to the Fed to do some quantitative easing, meaning that they actually start buying mortgage-backed securities again. That they actually, when they have to issue $100 billion for the deficit, they're issuing that money, but then buying it back. Right now, they're not buying it back. They're buying back very little of what they're issuing. They're buying some, but very little. And then that money's going into the environment, and that money has to be bought. Those treasury notes, the government needs a loan. China, other central banks have to buy that debt. And they're flooding the market with so much of it that it's causing the yield to keep on going up because they're not buying it. But they will start buying it again when inflation is more in line. They will start buying, and that will cause our yield curve inversion to change. Right now, if the government wants to issue money, they issue it, and they have a short term, like a couple months, 6-month coupon. You can lend the government money by buying their treasury debt at 2 years. You can buy it at 3, at 5, 7, 10 years. Normally, the shorter end of that is paying a lower return. If you're only lending out money to the government for 2 years, you're going to get, let's say, a 2% return. If you're lending it out to them for 10 years, you're going to get a 2.5%. 30 years, got 3%. Well, right now, the 2-year is at 5.2%, and the 10-year, if you let them, is at 4.6%. It's inverted. It's supposed to be lower to higher. But that can be solved the minute that the government feels that inflation in the next 2-year outlook is low and they can start cutting interest rates. When they see that they're going to be able to do that, they're going to start buying their own debt again as well, just like all the other central banks. And that yield curve inversion will probably flatten and then steepen. And it's just, we're just not there yet, you know? A lot of it has to do with this data right here. Now, what happened back a couple weeks ago that the Fed decided not to raise interest rates again, but why are rates going up higher? It's an adjustment to higher for longer. Their expectation on their federal fund rate, it was at zero right after COVID. I say after COVID, it's still going on a little bit, but you know, let's say early 2022 was at zero and they started to hike that interest rate. That rate now is 5.25% to 5.5%. They believe they might have to hike it again to 5.5 to 5.75 range, but then they believe in 2024 that they're going to have to lower that down to 5.1 as an average for the year. Prior to this last meeting, they were only expecting to lower it down to 4.6, so they raised it a half. Then in 2025, they're saying instead of 3.4 being their Fed fund rate that's going to be needed to keep inflation under control and get them back towards that 2% target, they're going to have to keep it at 3.9, higher for longer. That mixed with the Fed also stating that they're going to continue to perform QT, meaning all this money that we're going to print right now to cover the deficit because the government shutdown, that's probably not going to happen, hopefully. That money is going to have to get printed in the form of treasury bills, and then those are going to get sold into the market, and the government's not going to buy them. That's what's going to keep on causing yields to rise, right? Especially on the longer end of the curve. So, yeah, pretty. We're you know, I keep thinking maybe we're in the 8th inning. I think it's looking like we might still be in the 6th, and I hope not. But it's okay if we're in the 6th because we're still making progress. I just don't know how to forecast the last quarter of this year. It's going to be very tough. The smartest economists that are 100 times smarter than me, I'm not even an economist. I just watch this stuff very closely and have been for my entire career. But I'm just reading the data that I see, and then I feel the market because I do a lot of financing. And the smartest of the smart, man, they're having a tough time right now. It's going to be tough to forecast the end of this year and early next year. But at some point, inflation will get back to the Fed's target or close to it, and you're going to see interest rates come down with it. Here's a chart you can see back in 1971. Just real quick, inflation in the early 70s, you know, we had World War II, and then after that, the Fed had rates at zero for a long time to help economic expansion and really to help everybody move forward. I mean, it was just so hard on the economy, you know, and on consumer confidence when World War II happened. And so through the 50s and 60s, the zero money policy, there was this age of expansion, and there was a lot of oil drilling going on. And back then, oil ran the entire world. We were 100% an oil-based economy. You know, right now we have some alternative energy sources, and so when oil prices go up, it does affect the price of everything pretty much, but not at the level it did back then. Back then, when oil prices are going up, the cost of everything is going up dramatically. And so as you got through the 70s, we got to max output. And, you know, oil companies were not able to drill for any more oil than what they already had. They were at a point where the demand was outweighing the amount that they could pump and that they could get new oil. And then in the late 70s, we had the Yom Kippur War, and OPEC shut off their oil to the rest of the world. And what happened then is oil prices spiked to over $100 a barrel, and it caused hyperinflation. And then there was the Volcker app. Paul Volcker, who was the Fed chief at the time. Right now we have Jerome Powell. Paul Volcker had to raise interest rates to over 20% to slow down the economy, right? To slow it the heck down. And so interest rates on 30-year mortgages went over 18%. Back then a CD was paying 10. Right now a CD is paying, 5 or so. So it's much higher rates then than what we have now. But as you guys can see, even after that, it took time, but eventually inflation cooled out, 30-year rates, came down with it. And so we're going to see the same event happen. It's just about, we don't know if it's going to be within 3 months or 6 months or a year or 2 or 3 years. Nobody can yet put their finger on it directly. And I think a lot of that is because of
COVID just being so unique. Remember, I said the word unique. If you say something's unique, it's pretty much enough you can say it. This is a unique thing. Well, it was, like I said, very unique. It was unique in a way that the markets have never experienced. And so that's why there's still some unpredictability. And that's why the Fed raising the projection for next year to what they had previously and only showing basically one rate cut is problemsome to the market that's still operating off the fact that the Fed was going to cut more than that next year. And that's the adjustment that we're seeing right now still happen. But it's part of the sauce we need to get back to neutral. It's part of that sauce. So just real quick, what happens to mortgage rates when inflation cools down? What I have here is basically just a comparison between what was it like before COVID and what was it like after. And I don't know that we'll go back to the same situation, especially with technology continuing to advance and AI continuing to advance. And just, we're growing now, I think, at a pace that 2% might not be neutral anymore. They might need 2.5 to be neutral. They'll figure that out hopefully soon, or maybe 2 will stay neutral. But the point is, before that, the federal fund rate was about 2%. Right now, it's 5.25 to 5.5. Okay, the 30-year fixed rate before COVID, when we were at a 2% Fed fund rate, was 3.625 because inflation had come back into line. So even though the Fed fund rate was at 2%, 30-year fixed mortgage rates didn't have to be 4.875. They were fine at 3.625. So right now, the average mortgage rate is 7.35%. And the unemployment rate before COVID was 3.7, the same unemployment rate that we have right now. It was at 3.5, tick back up to 3.7. So I think what you guys are going to see is as inflation gets more back into line, you're going to see the spread between mortgage rates and the 10-year Treasury note. That spread right now, normally that spread is about 1.5%. So you can take your 10-year Treasury note, the 10-year debt that the government issues. It's the most closely correlated debt to mortgages because people tend to buy or refinance their mortgage every 10 years. It's the benchmark note that you would compare to a 30-year mortgage. The difference in that rate, that spread, when we're in more of inflation's not still unpredictable. It's predictable. It's going down now completely, and we know the Fed doesn't have to hike anymore. When we get to that point, in that type of environment, and then normally when you're in more of a normal neutral environment where things are growing at the natural rate, then that spread is usually 1.5% spread. So the 30-year fixed rate will be 1.5% higher than the 10-year T-note. Right now, the 10-year T-note is 4.6. The 30-year fixed mortgage rate is about 7.35. We are out of bounds. We're at 300 basis points. And that's because of still the hawkish nature of next year and even the following year now. When that comes more into balance, then you're going to see that 10-year and that 30-year. You're going to see the yield curve inversion change. You're going to go back. It's going to steepen. You're going to see money pour into the shorter end of the yield curve, meaning that the 2-year will uninvert. And you're going to see 30-year fixed mortgage rates just start to come more into balance with that 10-year gap of 1.5%, where right now it's over 3. So you're going to see that happen. And then longer term, as we get back to 7.5 million jobs available, or even a little lower than that, or if we get back there, hopefully in the next year or two, you're going to see wage inflation continue to find its way. You have all these strikes going on right now. The longer that these strikes go on, it actually hurts the economy because people are spending less money. Okay, so even if they get a 35% raise and all the other people that have to do with those jobs, because there's like 120,000 employees that are involved in this auto strike. Well, there's 6 times that many jobs that are tied to those 120,000 jobs. So if those jobs go up 35%, or 28 to 35% wage increases, all the other jobs around them are going to do the exact same thing. Okay, and so, but the point is, if they stay out of work for 30 more days, that's 30 more days of not spending into the economy. So that'll even itself out. And as you get through these labor strikes that are needing to happen so that people are making enough wages to pay for the price of things nowadays, as you get to that level and that point, and that starts to get behind us and inflation keeps cooling and the amount of available jobs comes more back into balance, then you're going to see that wage inflation come down with it. And so again, are we 3 months away? Are we 6? Are we a year? Are we 2 years? We're not sure yet on that, but we have made progress. How do we know that? Wage inflation was at nearly 6%. It's down to about 4%. Consumer price inflation was at 9%. It's now the annualized pace is about 3%. The 3-month average was at 2%, which is actually what the Fed's target was. But now with oil prices back up way high, you're going to see CPI tick up again. And cost to produce is now going back up again. There's a resurgence of inflation, but the point is we've already made pretty good progress and we're on our way. We're on our way. And you'll probably, like I said, you'll see it look not the same as before COVID, but it's going to be some new low is going to come around again at some point. I just don't know what that low is going to look like, but I'm sure it will be a lot lower than where we're at today, and definitely lower than where we're going to be at if they keep on going up, because they might need to go up more. So again, looking at that chart, about the average rate since 1971 has been 6.5%. Right now we're about 1% above that. This is my weekly market update. It goes out every Saturday. If you guys want to be added on, just shoot me an email. Say, hey, Reed, add me onto the update. It's just great info. It goes out every single Saturday, and that way you can stay on top of the market. All right, you guys, it's been great talking to you tonight, and you reach out to me anytime if you guys have questions. And, again, just when you look at the market, when you look at the jobs market, when you look at the state of the economy, the market has definitely been absorbing these higher rates. If they go up more, maybe there'll be more opportunities to buy. But I will tell you that sellers are very stubborn right now, and they're sitting on very, very low interest rates. And I think that with population growth over the next 20 years, and the biggest point is the amount of properties that we've been building since the last big recession. Coming out of the last recession, so we need to build about a little over 1 million homes a year we have to deliver to keep up with population growth. In this last recession, coming out of that, 2010, 11, 12, 13, we were building and delivering about 300,000 homes a year. There was that huge glut of properties on the market because people had foreclosed. And it took years for all that to get bought up. And then from that point, it took more years for construction financing to become appealing again for builders to build more property. And then now you're in this market where the last couple of years, there's been very little resale properties available, and new construction has been growing more rapidly, but we're still only building new home permits are about 1.45 million a year, and we're only delivering about 1 million, and then now in the most recent months with home sales dropping so much because of inventory, again, this all points to we're going to have a supply and demand issue for many years, and we're going to have a strong jobs market for many years. So take any downturn in the market as an opportunity to buy. Keep your eyes open as we get into the end of the year. There should be some good opportunities. And if you get a higher interest rate now and you can get the numbers to work, then at some point in the future, you guys will get a refinance for virtually no cost with us, and we'll bring that rate down. Okay? Guys, take care.
Thank you, Reed. That was awesome. You guys, make sure you reach out to Reed for any info. He is obviously a wealth of information. This is super helpful and really good intel on navigating the market.
Thanks, Rachel.
We have a couple quick slides after this one too. Let me see. There we go. Okay, so I always like to give a quick shout out. This is my favorite piece of educational content from our Learn page. If you guys haven't spent any time on there, that's definitely something I encourage you to do. Marshall Reddick is really big on our investors. We like to fund their education for free. That's a big deal. There's a lot of gimmicky companies out there that like to do sell you education. That is not how we like to run our business. We like to provide the educational platform and resources, and this is by far my favorite thing on there. It's a quick little 30-minute read that you're able to go through. Our CEO wrote this book, easy read, and it's great because it's applicable in any of our markets, just like it's great to work with Reed because he's able to help with financing in any of the markets. All right, real quick, and then we can wrap up for the evening. But if you are not currently working with an advisor, I'd be happy to set up a free consultation This is of no cost to you. I get paid out of our broker, his cut when we close on purchases. So this is a courtesy service we provide to all Marshall Reddick clients. It goes hand in hand, dovetails with our education. So I would be happy to provide an analysis on our different markets and kind of covering everything that Reed was talking about with how to get your pre-approval financing and applying that regardless of the direction you decide to go with your investment market. I work with our teams across the country all day, every day. So these are the different things you can expect when meeting with an advisor, and would love to sit down and do a financial overview, some goal setting, and then go from there. So with that, everybody, thank you guys so much for coming out tonight. That's a lot of really awesome info. We will have a copy of this recording posted to our education site. And with that, Reed, thank you so much for all that info. I hope everybody has a great night.
Take care, everyone.